Hi, this is Jyoti Prakash from PRP Edge with an update on markets. Last week, we saw sharp fall in equities on both sides of the Atlantic. Asia has fared better, and India continues to outperform. Inflation is a bigger problem in the West compared to Asia, and that probably explains the difference in performance. So, what are investors doing? They are buying insurance. So, we see a spike in volume of put options, show how investors are rushing to hedge against market correction. But India has fared better than the US. If we see, the US markets have revisited the June lows, whereas we have only corrected by 4% from recent highs. But is this discussion about India being decoupled from the US? How true is that? So we've looked at equity returns on 1 year, 3 years, 5 years, and 10 years time frames. And we also look at the performance on the local currency basis and in dollar terms. What we find is that the Nifty Midcap 100 has done exceedingly well across time frames, across currencies. So this decoupling or better than performance better than other markets is not something that's happening now. It's been happening over the last 10 years. Although near-term outperformance would obviously influence the overall returns. Now, looking at the brighter side of things, this chart tells us that whenever S&P 500 volatility reaches to the level of 28.6 or higher, the future returns are high. So we are there now. So in spite of the volatility that we are seeing, and markets can definitely go down more, but anyone who's investing from here can eventually hope for superior returns in 1 year, 2 year, 3 year, 5 year time scale. Now, when we look at the global picture and India in it, we see that Ceteris Paribus, 10% outperformance over Germany will take us to the 9th rank. And I think last week we would have outperformed by 3% already. India's fundamentals are strong. Last week we talked about GST collections. This week we are witnessing strong figures for direct tax collections, up 23% year on year. According to CRISIL, the health of Indian banks is improving. And by end of FY23, the gross NPA in the system is like to come down to 5%, and in FY24 fall by another 100 basis points to 4%. So for a change, Indian banks are not being perceived to be cyclicals. There another interesting analysis done by Kotak Mutual Fund, which says that India is one of those few countries which, in fact, the only country which has seen a drop in the debt ratio. Yes, the debt for the government has gone higher, but for households and corporate, it has come down. So the overall debt is not a worry for India. Even in US, the data is strong across parameters, and that's a problem because given that the data is still not weak, the Fed would be encouraged to carry on with the rate hikes till they are able to bring down the level of inflation. What we are seeing in this chart is that the liquidity has a direct bearing on the performance of the markets, and the liquidity tightening has only started. In fact, September is the month when the quantitative tightening is to reach to a level of $95 billion. And 3 weeks into September, we are still nowhere there. And so if markets are this bad, even without QT, what will happen if there is a $95 billion of quantitative tightening month after month? The P multiple has a direct bearing with the level of interest rates in the economy. And what this chart is trying to tell us is that given the current level of interest rates, the P multiple needs to go lower. I have read another analysis saying that the P multiple for Nasdaq is 25 today. Given the level of interest rate, it should actually be closer to 19. Coming to bonds, yields increased by about 25 basis points across the curve as market pricing Fed median dots of 4.25 to 4.5% for end of 22 and 4.5 to 4.7% at the end of 2023. So the pain is not over as yet. Now, this last week, there's been a massive discussion about what the United Kingdom has done in its latest mini budget. As Larry Summers put it, the UK seems to be behaving like an emerging market that's getting submerged. Now, the yields were up with 35 to 45 basis points a day. And so, therefore, we thought, this problem is going to be a contagion, but nobody probably thought that UK will be the first one that will get impacted. Now, what has happened in one FOMC meeting prior to that, the chart on the right, which we circulated last week, the peak interest rate was supposed to be 4.31%, one FOMC meeting, and now we are at 4.61%. That's the 25%, 25 basis points of shift in the curve that we mentioned earlier. Last week, we showcased how a high yield high duration ETF had fallen by 46%. Here is the Austria 100-year government bond, and that's fallen by 70%. And who thought bonds are safe? This is another slightly positive, if I may put it. The gap between 2-year and 10-year bond is currently at 51 basis points negative. It had fallen twice earlier this month to 58 basis point negative. So do we have a double bottom at place, and can we expect this inversion to reduce going forward? Now, we believe that it is better to buy bonds than to be buying equities, because what we are seeing is that the yield on bonds is almost as much as the earnings of S&P 500. So why buy equities when bond is going to give you the same yield? In May 2020, there were 21 countries in the world which had negative yields. Today, it's only one country, Japan. And maybe, who knows, even Japan may have positive interest rates in all tenors, maybe in the next few months. Now, here we are probably adding apples to oranges, but we had a Thursday when many central banks across the world had their monetary policy meetings. And what we saw that on that particular day, the total rate hikes across these countries was 462.5 basis points. We also have our MPC meeting on 30th of this month. And what are we expecting? We're expecting a 50 basis point rate hike. The stance might change to neutral, and the inflation probably will stay at 6.7% for the full year. And let's see if all the members are saying the same thing, or there'll be some members who will be wanting to go in for a lower hike given growth concerns. Now, this is an interesting analysis which I read on CMIE, that the G-Sec and US Treasury yield spread is at 12-year low. So on an average, on 10 years, the last 10 years, the spread between India 10-year and US 10-year was 518 basis points. For the last 20 years, it was 442 basis points. And currently, it stands at 376 basis points. So, which is, so again, it's not that equity alone is outperforming. We also find that Indian bonds are outperforming. Liquidity is definitely tightening in the Indian context. And for the first time in 40 months, we are seeing liquidity has slipped into deficit. And that is clearly seen even in T-bill auctions. The cutoff spike in 3 months, 6 months, 1 year T-bills has risen by 16, 24, and 22 basis points respectively. I don't think we have a firm grip on inflation today. Inflation can again surprise on the negative side. In the US, apart from the shelter inflation, what you find is that the grocery prices are up to 13.5% over the last 12 months. Even in India, we know that the price of rice and wheat have been on the upward trajectory. So therefore, to say that the worst of inflation is behind us would be too early to say that. Interest as the button is going up with rising yields. The outstanding bonds have to be refinanced at a higher rate, and this is becoming the biggest item in the P&L of a government. Even in India, There's some report I saw where the average weighted cost of Government of India bonds is 6.5%. And if today, part of it and the interest rates don't come down, have to be refinanced at 7.5%, that would mean extra fiscal pressure. Recession, definitely, Germany is a lead indicator of whether there's going to be recession in the world. And it clearly shows that Germany's exports is faltering, and which basically means that the demand across Europe and China and all that is not good. So recession is there to be sure. Now, we also devote some time to asset allocation every week, and there's a very nice, beautiful analysis done by Ravi Sharogi, and which is these graphs are published in the Mint newspaper. What it is trying to tell us is that if you're in your given expected returns from equities and bonds for a 60-40 portfolio, 60% in bonds, one person should only spend 3% of retirement corpus so that he or she does not run out of money. Coming to crude oil, gold and INR, crude oil corrected sharply by nearly 6%. Gold is down 2%. Indian currency depreciated by 1.4%. 81 has been taken now. Now, talking about crude oil prices, the reasons why it has fallen, interest rates going up, equity markets have been wobbly, US dollar has been strong, US dollar, the dollar index has touched the handle of 113, recession or slowing growth is there for everyone to see, and supply is more than the demand. Of course, there will be uncertainties about OPEC production. When they meet on 5th of October, they might cut their output, and US refilling its strategic reserves, or Russian output getting hit because of greater embargo. Don't write off gold as yet. We expect it to make a comeback by end of December. It's an asset class which does well in during recessions. REITs and InvITs continue to outperform in bad markets. When there is sell-off in risk assets, it does well, and last week was no exception. Here are the data releases last week. Foreign exchange reserves have fallen by $5 billion to $546 billion. And this is now, according to Morgan Stanley, is about 8.5 months of import cover. The food grain production is likely to be lower by 4% because of erratic monsoons. And while cumulative rainfall is up 7% from long period averages, the spatial distribution has been poor. Thank you for paying attention. Have a wonderful week ahead, and see you next week again.